Asset allocation is a crucial part of investing. Investor portfolios should consist of different assets that over the long term can beat inflation. Apart from equities and debt, an investor's portfolio should also consist of investments in precious metals such as gold. Although there have been long periods when gold delivered no returns, like 1992 to 2001 or 2012 to 2019, it has still managed to beat inflation. In INR terms, over the last 10 years, gold has delivered around 9% per annum. Over the last 20 years, gold has delivered around 12% per annum, while over the last 30 years, gold has delivered around 9% per annum returns. To invest in gold, you can buy physical gold or jewelry, gold ETFs, or invest in the sovereign gold bonds or SGBs. In this video, we will introduce you to the concept of sovereign gold bonds. The sovereign gold bonds are issued by the Government of India and the RBI. Only the Government of India can issue this bond as per the GS Act of 2006. This bond was introduced in November 2015 to reduce the physical gold market and increase transparency. The gold bought through the SGB route is stored in the demat account or is issued as a certificate. The purchase price is determined by the last 3 days' average price of gold as on the date of purchase. At the time of redemption, a similar price is calculated and the amount is deposited into your bank account. You can purchase the SGBs through authorized brokers, banks, and financial institutions. Any individual, HUF, charitable institution, and universities can invest in the SGBs. Even minors are allowed to invest in the SGBs through their guardians. The minimum investment is 1 gram and the maximum is 4 kilograms per individual. The tenure of the SGB is 8 years, but the amount can be redeemed from the 5th year itself. The best part of the SGB is that it pays you an interest of 2.5% per annum. So if you invest rupees 1 lakh in this bond, you are paid rupees 2,500 every year in 2 installments, which means you get rupees 1,250 every 6 months. So why should you invest in SGBs? Well, we recommend an investor to have around 10% of their portfolio in gold. The SGB route is the best way to invest in gold as it is safer and offers 2.5% more returns over physical gold or gold ETFs. Moreover, if you stay invested till the maturity, that is 8 years, you pay no tax on the returns. The calculation on your screen shows how SGBs outperform physical gold and gold ETFs over the long term, assuming a 6% per annum returns from gold over 8 years. The returns can be in excess of nearly 3% per annum, which translates into a big amount over the long term. Not just the returns, the SGBs are better than physical gold and ETFs even in terms of safety, purity, and taxability. The only drawback is that they are not as liquid as the physical and ETF gold. Now, what if you want to invest in gold for your child's wedding? Isn't physical gold a more logical choice? No, SGB is. Suppose your child is 15 years old and their wedding is 10 to 12 years away, you can invest in SGB now and 8 years later with the redemption amount you can go ahead and buy the jewelry at that time. You will earn a 2.5% interest on SGBs which you wouldn't have earned on the jewelry.